Welcome to the Explainer. You know, there's this one common mistake in company analysis that could be costing you. And today, we're going to bust a major myth about profit. Let's jump right in.
So, let me ask you something. When you're comparing two companies, what's the first thing you look at? Be honest. Is it the profit margin? It's a really common assumption to think the higher margin is better. But today, we're going to ask, is that really the whole story?
Okay, so before we tear this whole idea down, let's actually get on the same page. We'll start by breaking down what a profit margin really is and, why it's such a magnet for investors in the first place.
So profit margin, at its core, is actually pretty simple. It's just the percentage of money a company gets to keep after paying for everything. Think about it like this. You buy a pencil for 10 rupees, you sell it for 15. You just made a 33.3% profit margin. Simple enough, right?
And you can see the logic, right? The higher the margin, the better the business. It feels so airtight. But what if I told you that by focusing only on this number, you might be missing out on some truly fantastic businesses? Okay, to really see why, let's bring in a much more powerful way to measure a business's success. And we're going to do it with a simple story about two entrepreneurs. All right, let's meet our two guys, Ram and Shyam. They both start out with 100 rupees to get a pencil business off the ground. Now Ram, he goes for the high price strategy, selling his pencils for 20 rupees each. That gives him a whopping 50% profit margin. Shyam, on the other hand, takes a totally different approach. He sells his for 15 rupees, which gives him a lower margin, just 33.3%. Okay, so just looking at the numbers on the screen right now, who would you bet on? Come on, the obvious answer seems to be Ram, right? He's got that much higher margin. But let's see what actually happened.
And boom, here is the twist. Shyam's lower price? It meant he sold 3 times as many pencils as Ram. So even with a smaller profit on each individual pencil, his total profit was way higher. But here's the most important part. He generated a much, much higher return on his initial 100 rupees. He made his money work so much harder.
And this brings us to a really crucial concept, return on equity, or ROE. See, it's not about how much you make per sale. It's all about how much profit you can squeeze out of the total cash you've put into the business. It's really a measure of pure efficiency.
Okay, so this isn't just some made-up story. Let's look at this principle in action with real companies. You've got Eicher Motors, and they have a solid 20% profit margin. Pretty good. But then you have Page Industries. Look at this. Their margin is lower at 13%, but their ROE is almost double. They are just incredibly efficient at turning their capital into profit. And they do it by focusing on high sales volume. So, the answer is simple then, right? We should just hunt for the company with the highest ROE? Well, not so fast. A really high ROE can sometimes be a red flag, and it can be masking a pretty significant risk. Let's dig into why.
All right, just imagine two companies for a second. Both need 100 rupees to operate. Company A gets all of that money from its shareholders. But Company B is a bit different. It gets 50 from shareholders and borrows the other 50. Now, Company B's profit is going to be a little lower because it has to pay interest on that loan. But, and this is the key part, its ROE is actually higher, because that profit is being generated from a much smaller amount of shareholder money.
Yeah, this chart just makes it crystal clear, doesn't it? Debt can act like a lever, kind of artificially boosting that return on equity number. Company B looks way more attractive on paper, but that higher return comes with a very real and often hidden danger.
And here is the catch. This is the big one. Shareholders, well, they get paid if there's a profit. But the bank? Oh, the bank gets paid no matter what. Those interest payments are non-negotiable. And if a company hits a rough patch, that debt can literally sink the entire ship.
Okay, so if a high margin isn't the whole story, and a high ROE can be really deceiving, what in the world should we be looking for? What is the real winning combination for investors?
Let's go back to our two companies, Eicher and Page, but this time we're adding one more crucial piece of information, the debt-to-equity ratio. And just look at this. Both of these companies achieve their impressive returns with almost zero debt. That is the hallmark of a truly high-quality business.
So, if there's one thing you take away from this explainer, let it be this simple two-part framework. You want to look for companies that generate a high return on the money invested in them, that's the ROE, and crucially, you have to make sure they're doing it on their own steam without relying on a mountain of debt.
And that's our explainer for today. The next time you're looking at a company, I really hope you'll look past that flashy profit margin. Instead, ask yourself, what story is its ROE and its debt level really telling you?
Thanks for joining us on The Explainer.